Luxembourg is certainly not resting on its laurels as Europe's premier fund centre. Indeed, some people say it's at something of a crossroads between the old and the new. Rather than investing purely in the traditional assets of equities and bonds, the Grand Duchy is developing the alternative strategies, such as private equity. After all, that's where the demand from new investors is coming from. We're here to meet Justin Partington, Head of Fund Solutions at SGG, to discuss these issues. Do you feel Luxembourg will really become a centre to be reckoned with in terms of strength and skill in alternative investing?
The knowledge and the skill base has grown over the last 10 years in particular. The products are in the right place, and Luxembourg is capturing market share. There are other domiciles, clearly, in the market, but what I think Luxembourg does to stand out is to bring all those elements together in a neat packaged way, and of course continue to appeal to EU investors. So there's a strong push from EU investors to have a domicile like Luxembourg involved in the fund structure. There are other domiciles out there for other regions that have other strengths. Luxembourg is taking its share of the market.
Because of course hedge funds had their heyday before the financial crisis, and a lot of private investors and institutions pulled out of them. Can the private equity funds replace the hedge funds, do you feel?
I've spent time in both the hedge world and the private equity world for the last 20 years, and I think what's really apparent is that they are very different offerings. One of the challenges and the headwinds that hedge funds are facing is justifying the fees in the face of fairly lackluster returns, particularly among the European hedge fund community over the last 5 years, post-crisis, and also maintaining that hedge structure to it so that in good times and bad you have a steady return. So PE has consistently generated good positive returns before the crisis, through the crisis, and now in current times with peak fundraising, and continue to get a lot of demand in terms of attractiveness of PE investing. So I see them as different products. Clearly private equity is at a very high point in its current fundraising cycle. Very positive, exits are strong, and European hedge is still trying to recover from a bit of a tail off in the last few years. But if you look at US hedge and Asia hedge funds, there is now a growth rate over the last few years. So it does depend a bit on the geographic region. Ultimately, if you're managing money for the investors, you have to return at a level that justifies the fees that are involved.
You have a very positive view of the future for alternative investments.
And the market data supports that. This is a time where fundraising is a peak high, investors are still very keen to put money into alternative assets, private equity and real estate in particular, with some into hedge. There's a strong demand from the investor community, so they see a strong future ahead for the alternative industry here in Europe and Luxembourg.